What is angel investment? Well, oftentimes startup ventures seek funding, equity funding, from outside investors, that is, individuals who are willing to purchase an ownership interest in these startup ventures in exchange for money. The startup venture uses the money to grow. Now, the objective behind this is that the investor, angel investor as you will, it generally takes that name because they're thought of as saving angels that come in and provide much needed capital to a business that otherwise would not be able to grow and succeed without this outside investment. So these individuals come in and purchase an ownership interest. Now, who are these individuals? They are generally high net worth individuals. That is, they've acquired, inherited, earned, made somehow lots of money. And they take a percentage of their overall portfolio. They'll invest like everyone else in mutual funds, stocks, bonds, alternative investments, and one portion of their portfolio will be higher risk investment in early stage business ventures. Business ventures that have the potential for high return, but in turn have a high probability of failure and complete loss of money. So with this being said, an angel investor generally looks to invest in the type of startup venture that is scalable. It can reach a large number of people and has a repeatable business model. That is, you create the value proposition one time and then that can be replicated to many, many customer clients and users. And in this way, again, it's more scalable because created one time, repeatable. It's easier to service thousands, millions of people with the same value proposition than to create the value proposition anew each time. And if the market's big enough, if the potential return on investment is enough, the investor is willing to put their money in there. Normally, an angel investor cannot mathematically put money into this type of venture for less than a potential 20 times, 30 times, 40 times return on their investment over a 3 to 5 year period. The reason is because of the high level of risk, and the level of risk needs to match the level of return. And so that's what they're looking for ultimately. And so how do they go about investing in business ventures? Well, they either do it individually, which has become much less common, unless the angel investor is experienced. Sometimes angel investors are entrepreneurs who have been successful on their own. They have sold large businesses and things like that, and they have tons of capital to reinvest in startup ventures and hopefully repeat the process or repeat the success they had in their own entrepreneurial venture. In this scenario, these types of angel investors will go it alone. They'll invest on their own. But more commonly now, angel investors come together in groups. They pull their money together and they invest collectively as a group, an angel group or angel pool. And they invest much in the way a venture capital firm would, except that they don't have professional money managers who are allocating money to the entrepreneurial ventures on their own behalf. They meet with the entrepreneurs. They review the entrepreneurial venture, its operations, everything about it. They make the determination of whether to invest or no. They negotiate the terms of investment. They hire outside legal professionals and accounting professionals to memorialize the transaction, to comply with the securities laws, and to conduct due diligence. And once all this is complete, they invest in the business venture directly. And oftentimes they'll form an LLC collectively to hold the ownership interest collectively rather than hold it as partnerships together. So that's generally how they invest. Now, once again, the important thing to remember about angel investors is they don't invest in every type of business. They only invest in these growth-based startup ventures. Small businesses that have a gradual growth path are not attractive to them. These, once again, they have to have some level of growth that has a potential return that's commensurate with the level of risk and potential of failure. And again, it requires a good deal of effort on their part to actually find the deals, to negotiate the terms and make the investment and follow out the process for 1, 3, 5, 7 years, however long the investment is deemed to take. So This, once again, is a valid form of investment for startup ventures and is a valid form of asset allocation for high net worth individuals.